In the third week of January 2026, something happened that should terrify anyone who understands global finance. Over $45 billion poured out of China-mandated equity funds in 7 days. Not over months, not gradually, 7 days. According to EPFR Global data, this was the largest single-week outflow in history. But here's what nobody's telling you. This wasn't a panic. This wasn't a crash. This was a calculated exit. Wall Street saw something, understood the implications, and pulled the ripcord. And if you look at what triggered it, you'll understand why the second largest economy on Earth just crossed a line it can never uncross. This isn't about trade wars. This isn't about tariffs. This is about the moment Western capital realized that China's government will sabotage its own markets to maintain control, and that fundamental decoupling, the financial separation of China from the Western system, isn't coming. It's already here. Let me show you exactly what happened, why it happened in 7 days instead of 7 months, and why this marks the end of the 4-decade experiment of Western capital flowing into Chinese markets. Before we dive into January 2026, you need to understand the baseline. Foreign investment in China has been collapsing since 2021. Net foreign direct investment peaked at $344 billion in 2021. By 2023, it had fallen to $42.7 billion, the lowest in more than 2 decades. And in the first half of 2024, net FDI went negative for the first time. Negative, meaning more money was leaving China than entering it. This is unprecedented for an economy that has relied on foreign capital inflows for 40 consecutive years. The equity markets told the same story. From early 2021 to early 2024, Chinese stock markets lost over $7 trillion in value. That's not a correction. That's a wealth wipeout. The CSI 300 index, the Shanghai Composite, the Shenzhen component, all in multi-year bear markets. Foreign investors had been steadily withdrawing. In 2023 alone, $182 billion in net capital left China. The trend was clear. Foreign capital was repositioning to India, Vietnam, Indonesia, anywhere but China. But then something changed in late 2024. Chinese authorities launched a massive stimulus effort. They cut interest rates, they injected liquidity, and most importantly, they deployed the national team, China's state-backed sovereign wealth funds and institutional investors, to buy stocks. Massive buying, trillions of yuan. The markets rallied. The CSI 300 surged. By December 2025, China equity funds were pulling in over $7 billion per week for 2 consecutive weeks. The largest weekly inflows since 2015, foreign investors started to believe. Maybe Beijing was serious about supporting markets. Maybe the worst was over. Maybe this was the turnaround. And then January 2026 happened. On January 14th, Chinese regulators made an announcement. They were raising the minimum margin requirement for stock purchases from 80% to 100%. Effective January 19th. This was framed as a counter-cyclical adjustment to moderate leverage levels and promote long-term stability. Translation. Beijing was terrified that the rally was getting out of hand, that speculation was building, that retail investors were piling in with borrowed money. So they tightened the rules, made it harder to buy stocks on credit. On the surface, this seems reasonable. Regulators cooling an overheated market, standard central bank toolkit. But here's what nobody initially understood. This wasn't just tightening, this was a signal. Beijing was telling the world, we will not allow our markets to rally freely. We will control the pace. We will decide when stocks go up and when they don't. And if you're betting on a sustained bull market, you're betting against the Chinese government. And the Chinese government doesn't lose. The markets didn't react immediately. On January 14th and 15th, stocks dipped slightly but held. Investors thought, okay, this is just managing speculation in tech stocks. The broader market is fine. But then January 16th arrived, and that's when the floodgates opened. The national team started selling, not just trimming positions, not just profit-taking, selling in massive volumes, record volumes. The Huatai Pinebridge CSI 300 ETF saw $2.9 billion of outflows on January 16th, the largest single-day outflow since the fund's inception in 2012. The eFund CSI 300 ETF, the China AMC CSI 300 ETF, all hit record outflows. In total, the national team sold about $10 billion worth of ETFs on that single day. Thursday, January 16th. Bloomberg Intelligence estimated that over the following 6 sessions through January 23rd, Central Huijin Investment, the sovereign wealth fund that anchors the national team, sold $67.5 billion across 14 ETFs. $67.5 billion in 6 trading days. Here's what that means. For years, the national team has been the backstop. When markets crashed in 2015, the national team deployed $158 billion to stabilize prices. When markets faltered in 2022 and 2023, the national team bought. It was the one constant. If you owned Chinese stocks, you knew that Beijing would support the market when things got bad. The government wouldn't let it collapse. That was the implicit guarantee. But in January 2020X, the script flipped. The national team wasn't buying to support a falling market. They were selling to cool a rising one. For the first time in modern Chinese market history, the state was actively fighting against its own rally. And Wall Street saw it. They understood immediately. If Beijing will deploy the national team to sell when markets are going up, then there is no floor. There is no support. There is only control. And control means the government decides your returns, not fundamentals, not earnings, not growth, the government. And if the government can cap your upside whenever it wants, why stay? Why hold Chinese equities when the biggest risk is that your investment does well? Because that's when Beijing intervenes to push it back down. This is the week that Wall Street pulled $45 billion. Actually, the data is even worse. EPFR Global tracked $49.2 billion in outflows from China equity funds in the week ending January 22nd, the largest single-week outflow ever recorded. Not just for China, the largest for any equity market ever tracked by EPFR. Combined with $16.08 billion leaving U.S. equity funds the same week, global equity funds recorded $43.2 billion in total outflows, the largest on record. But China led the exodus, $49.2 billion in 7 days. Here's the breakdown. Institutional investors, the ones who move markets, pulled out. Pension funds, sovereign wealth funds, asset managers, the smart money, they weren't selling because of fear. They were selling because of clarity. The January 14th margin financing change wasn't just a regulatory tweak. It was Beijing declaring, we are more afraid of a market rally than a market collapse. We will prioritize stability over returns. And for foreign investors who've watched Chinese regulators tighten data laws, crack down on consultancies, ban foreign phones from government offices, impose exit bans on executives, this was the final confirmation. China doesn't want foreign capital, at least not capital that demands returns. But here's where it gets darker. The margin financing change and the national team selling weren't isolated. They were part of a broader campaign. On the same day, Chinese regulators also announced new restrictions on high-frequency trading. They forced brokers to move their servers away from exchange data centers, eliminating the low-latency access that high-frequency traders depend on. They defined transactions above 300 per second as programmatic and subject to special scrutiny. This targeted both domestic and foreign algorithmic traders, but the effect was clear. Beijing wanted to slow the market down, make it less volatile, more controllable. Then there were the individual stock interventions. Multiple tech stocks were halted mid-session for abnormal trading. Accounts engaging in excessive speculation were suspended. The Shanghai Composite Index fell 2.1% from its January 14th peak to January 16th close. The Shenzhen Component Index dropped 1.2%. The CSI 500 Index fell 1.5%. These aren't crashes, but they're signals. Beijing is managing prices directly, and when a government manages prices, markets stop being markets. They become policy tools. Now let's talk about why this matters beyond just Chinese stocks. This is about decoupling, real structural financial decoupling. Since the 1980s, Western capital has flowed into China based on one assumption: growth. China was the growth story. 8% annual GDP growth, hundreds of millions lifted out of poverty, the fastest industrialization in human history. If you wanted exposure to growth, you bought China, but that story is dead. Real GDP growth in 2025 was probably 2.5 to 3%, not the official 5%. Fixed asset investment turned negative mid-2025. Producer prices have been in deflation for years. Domestic consumption is weak. The property sector, which represents 30% of the economy, is collapsing. The growth story that justified the risk is gone. And now the risk is clarifying. It's not just economic risk, it's political risk. Beijing's closure of foreign due diligence firms, the revised anti-espionage law, the exit bans on foreign executives, the push for self-reliance, and technology. The Made in China 2025 policies that explicitly favor domestic firms over foreign ones. The new company law that requires worker representatives on boards, which everyone understands, means Communist Party representatives. The crackdown on data access, making it impossible for foreign investors to properly evaluate opportunities. All of this adds up to a single message. China wants to control everything, and foreign capital is a necessary evil to be tolerated, not welcomed. The trade war with the U.S. makes it worse. President Trump imposed tariffs on Chinese goods. He threatened 60% tariffs during his campaign. Even after some rollbacks, the U.S.-China trade relationship is fundamentally damaged. And it's not just the U.S. The EU has imposed anti-dumping duties on Chinese steel, solar panels, electric vehicles. Vietnam, Korea, India have all raised tariffs on Chinese products. China's export-led growth model is hitting walls everywhere. And when exports slow, the last engine of Chinese growth stalls. So what is Beijing's response? more control, more intervention, more stability. They want a slow bull market, gradual gains, tightly managed, no volatility. But investors don't want slow bull markets. They want returns. They want risk-adjusted returns that compensate for the political uncertainty, the legal uncertainty, the currency uncertainty. And Beijing is saying, you can't have that. You get what we allow. And if what we allow is 3% annual gains with the constant threat that will cap any rally, why stay? That's the question Wall Street answered in January 2026. The answer is, don't stay, get out. And they did. $49.2 billion in 1 week. That's not a sell-off, that's a rout. But it's a rational route. The institutions that pulled out aren't panicking. They're repositioning. They're acknowledging reality. China is decoupling itself from Western capital markets, and Western capital is decoupling from China. Let me show you the mechanics of how this plays out. When foreign investors sell Chinese stocks, they need to convert yuan into dollars or euros or yen. They repatriate capital. This puts downward pressure on the yuan. Beijing's response? Capital controls. They slow the outflows, make it harder to move money out. They force foreign investors to jump through bureaucratic hoops. This traps capital. And when capital is trapped, more investors want to leave. It's a self-reinforcing cycle. The more Beijing tries to control outflows, the more investors want out. And the more investors want out, the more Beijing tightens controls. This is the financial decoupling cycle. And we saw it start in real time in January 2026. Chinese authorities raised the margin requirement not just to cool speculation, but to reduce leverage in the system. Because if highly leveraged investors start panicking, forced selling accelerates. By raising the margin requirement to 100%, Beijing is essentially saying, we will reduce systemic risk by making it impossible to borrow for stock purchases. That's a defensive move. That's not the action of a confident market regulator. That's the action of a government preparing for capital flight. And the national team selling? That's even more revealing. Central Huijin Investment is a sovereign wealth fund with effectively unlimited yuan liquidity. They can buy as much as they want. They proved this in 2015 when they deployed $158 billion. So why are they selling in 2026? Because Beijing wants to drain liquidity from certain parts of the market, specifically tech stocks. The onshore tech gauge was up 11% in January before the interventions. That's too fast. That's speculative. That's retail investors piling in. Beijing doesn't want retail investors getting rich in tech stocks because when those stocks crash, those same retail investors will blame the government. So better to cap the rally now, manage expectations, and prevent the bubble from forming in the first place. This is the CCP's logic. Prevent problems before they occur by controlling everything. But the cost is that nobody trusts the market anymore. If the government will cap your upside to prevent potential future problems, then Chinese stocks aren't investments, they're controlled assets. And foreign institutions don't invest in controlled assets when they have alternatives. India, Vietnam, Indonesia, even South Korea and Taiwan all offer growth exposure without the political interference, so capital flows there instead. Now let's zoom out and look at the bigger pattern. This isn't the first time Beijing has sabotaged its own markets. In 2015, they did the opposite problem. Markets were rallying too fast, retail investors were over-leveraged, and when the bubble popped, Beijing panicked. They banned short selling. They restricted selling for major shareholders. They arrested journalists who reported negatively on markets. They deployed the national team to buy. They succeeded in stopping the crash, but at a cost. Markets became less credible. Foreign investors understood China's markets aren't free, they're managed. And managed markets are only good when the management works in your favor. In 2020 and 2021, Beijing cracked down on tech companies. They killed Ant Financial's IPO days before it was set to raise $37 billion, the largest IPO in history. They fined Alibaba $2.8 billion for antitrust violations. They forced Didi to delist from the US. They essentially destroyed the Chinese tech sector's valuation, wiping out hundreds of billions in market cap. Why? Because Beijing was afraid of billionaire entrepreneurs with too much power. Jack Ma, the founder of Alibaba, had publicly criticized Chinese regulators, so they destroyed his company's value and forced him into semi-retirement. Message sent, nobody is bigger than the party. Foreign investors saw this and pulled back. If the government will destroy a company because the founder criticized regulators, then fundamentals don't matter. Political compliance matters. And you can't build an investment thesis around political compliance. It's unknowable. It's arbitrary. So foreign investors reduced exposure. And now in January 2026, they're reducing it further. Because the pattern is clear. Beijing values control over growth. They value stability over returns. They value party supremacy over market efficiency. And those values are incompatible with Western capital allocation. Here's the specific mechanism of why January 2026 was the breaking point. The margin financing change was announced January 14th. Markets dipped slightly. Then, on January 16th, the national team started selling. That same day, turnover in national team ETFs surged to 40 billion yuan in the first hour of trading, more than double the average full-day level over the past year. That's panic selling. Not by retail investors, by the state. The state was panic selling its own rally. And if the state panics when its own markets rally, what does that tell you? It tells you the state doesn't believe in the rally. They think it's unsustainable. They think it's speculative. They think it's dangerous. And they're willing to kill it before it grows. Foreign investors watched this happen in real time. They saw the ETF outflows. They saw the turnover spikes. They saw the intraday volatility. And they made a decision. If Beijing will fight its own bull market, then there's no reason to stay. Because the only way Chinese markets go up sustainably is if Beijing supports them. And if Beijing is actively suppressing them, they won't go up. So why hold? And over the next 7 days, $49.2 billion exited. The smart money left first, asset managers, pension funds, sovereign wealth funds, the people who understand systemic risk. They weren't selling because of fundamentals. They were selling because of policy. And policy is more powerful than fundamentals in China. Now let's talk about who's holding the bag. Chinese retail investors. There are 200 million retail investors in China. Most of them don't follow global capital flows. Most of them don't understand margin financing rules. Most of them just see stock prices going up and want in. So when the rally started in late 2024, they bought. And when the rally accelerated in early January 2026, they bought more. They used margin financing at 80% to leverage their bets. And then January 14th hit. Margin requirement raised to 100%. That means anyone who wants to buy on margin now needs to put up the full value of the shares. No leverage for new positions, but existing positions are grandfathered in. So the people who were already leveraged at 80% are stuck. They can't add to positions without full capital, but they can't easily exit either because selling would crystallize losses. So they're trapped. And when the national team started selling on January 16th, retail investors saw their gains evaporate. The stocks they'd bought, hoping for a sustained rally, stalled out. Some dropped. The CSI 1000 index, which is heavy with small cap tech stocks that retail investors love, saw massive intraday volatility, up 2% in an hour, then down as the national team sold ETFs tracking that index. Retail investors saw this and panicked, but they couldn't sell easily because margin calls were coming. If your leveraged position drops below the maintenance threshold, you have to put up more money or the broker liquidates your position, forced selling, which drives prices down further, which triggers more margin calls. This is the death spiral. Beijing knows this. That's why they raised the margin requirement before the spiral started. They're trying to prevent the 2015 crash from repeating, but the cost is that they killed the rally and killed foreign investor confidence. Because foreign investors understand if Beijing will sacrifice market returns to prevent systemic risk, then Chinese markets are risk management tools, not growth vehicles. And you don't allocate to risk management. You allocate to growth, so capital leaves. Here's the data that confirms the exodus. EPFR Global tracks over 25,000 mutual funds and ETFs. They monitor $50 trillion in assets under management. Their data is the gold standard for fund flows. And their data shows that China equity fund outflows in the week ending January 22nd, 2026 were $49.2 billion. The previous record weekly outflow was $18.9 billion in 2015 during the crash. This wasn't a crash. This was a controlled exit during a rally. That's worse, because it means investors aren't fleeing panic. They're fleeing policy. And you can fix panic. You can't fix bad policy without changing the government. And the government isn't changing. The breakdown by fund type is revealing. Actively managed China equity funds saw massive outflows. These are funds where professional managers pick stocks based on fundamentals. They're leaving because fundamentals don't matter in a controlled market. Passive index funds saw outflows too, but less severe, because passive funds just track indexes. They don't care about policy, they just follow the benchmark. But even passive flows are negative, meaning institutional investors are reducing their overall China allocation across all strategies. That's the definition of de-risking, and it's happening at scale. The geography matters too. U.S. domiciled funds led the outflows. American investors, who've been reducing China exposure since 2021, accelerated exits in January. European funds followed. European pension funds and asset managers have been cautious on China since the Ukraine war started, fearing Beijing might invade Taiwan and face similar sanctions as Russia. January 2026 confirmed their caution was justified. Even Asian funds saw outflows. Japanese, Korean, Singaporean investors all reduced China exposure. The only inflows came from mainland China domiciled funds, meaning domestic investors. But those are often state-controlled. So Beijing is backstopping its own markets with its own money while foreign capital flees. That's unsustainable. Let's talk about where the money's going. India, Vietnam, Indonesia, Taiwan, South Korea, even Japan, anywhere with growth potential that isn't actively sabotaging its own markets. India has its own issues, but the Modi government is pro-business, pro-market, and welcomes foreign capital. India equity funds pulled in over $12 billion in the first 3 weeks of January 2026. Vietnam is growing at 6 to 7% annually, manufacturing is relocating from China, and the government is liberalizing markets. Vietnam equity funds saw record inflows. Indonesia is benefiting from the commodity supercycle, growing its middle class, and has stable governance. Indonesia equity funds posted 10 consecutive weeks of inflows through January. The pattern is clear. Capital is reallocating from China to the rest of Asia. Not because Asian markets are perfect, but because they're better. Better governance, better transparency, better rule of law, better respect for foreign capital. China had a 40-year run as the destination for foreign investment. That run is over. The decoupling isn't coming. It's here. In January 2026 was the moment Wall Street acknowledged it. Now, let me show you why this matters beyond markets. This is about the global financial system. Since 2001, when China joined the World Trade Organization, Western capital has been deeply integrated into Chinese growth. U.S. pension funds own Chinese stocks. European insurance companies own Chinese bonds. Japanese banks have exposure to Chinese credit. This integration was supposed to be stabilizing. The idea was, if Western capital is invested in China's success, then China has incentive to play by the rules, trade fairly, respect intellectual property, maintain stable currency, integrate into the global system. But Beijing never accepted that logic. They took the capital but kept the control. They opened some markets but kept others closed. They allowed foreign investment but maintained capital controls. They joined the WTO but subsidized state-owned enterprises in violation of trade rules. They took everything the West offered and gave back as little as possible. And now, when Western capital is pulling out, Beijing's response isn't reform. It's more control, more intervention, more capital restrictions. They're choosing control over capital, and that choice has consequences. The immediate consequence is currency pressure. When $49.2 billion exits Chinese equity markets in 1 week, that's downward pressure on the yuan. Beijing responded by having state banks buy yuan in offshore markets. They deployed currency intervention to stabilize the exchange rate. But they can't do that forever. China's foreign exchange reserves are $3.1 trillion. That sounds like a lot. But $254 billion left illicitly in the 4 quarters through mid-2023, according to Wall Street Journal calculations. Another $182 billion in net capital outflows in 2024, and now $49.2 billion in 1 week in January 2026. If this pace continues, even $3.1 trillion won't last long, especially because most of those reserves are in U.S. treasuries. If Beijing has to sell treasuries to defend the yuan, that puts upward pressure on U.S. interest rates, which hurts American markets, which creates a feedback loop. This is the systemic risk. China and the U.S. are financially intertwined. China holds $682 billion in U.S. treasuries as of November 2025, down from $688 billion in October. They're already selling, slowly. But if capital flight accelerates, they'll have to sell faster. And if they sell faster, treasury yields rise. If treasury yields rise, borrowing costs in the U.S. increase. If borrowing costs increase, the U.S. economy slows. If the U.S. economy slows, demand for Chinese exports drops. If exports drop, China's growth slows further, which triggers more capital flight, the decoupling spiral. This is why January 2026 matters. It's not just $49.2 billion. It's the signal. The signal that foreign capital has lost confidence. And confidence, once lost, is nearly impossible to rebuild. Beijing would need to fundamentally reform. Open markets. Respect property rights, allow free capital flows, accept transparency, give up control. But the CCP will never do that. Control is the entire point of the system. They'd rather have slow growth with total control than fast growth with partial loss of control. And that choice means foreign capital stays away, permanently. Let me walk you through the 3 possible scenarios from here. Scenario 1, Beijing doubles down. They increase capital controls, make it harder to move money out, expand the national team interventions, force state-owned enterprises to buy stocks. This stabilizes markets in the short term, but it accelerates the decoupling. Foreign investors who still have exposure will exit as soon as they can, and new capital won't come in. This leads to a closed system. Chinese markets become purely domestic, funded by Chinese savings, controlled by Chinese authorities, with no foreign participation. This is the North Korea scenario. Extreme, but not impossible. Scenario 2, Beijing reforms. They ease capital controls. Genuinely open markets. Stop intervening so aggressively. Accept volatility in exchange for foreign capital. This could work. Foreign investors would come back if they believed the rules had changed, but this requires the CCP to give up control. And they won't. Every time they've faced a choice between control and growth, they've chosen control. 2015, 2020, 2021, 2026. Same pattern. So this scenario is unlikely. Scenario 3, muddle through. Beijing does just enough to prevent collapse, but not enough to attract capital. They maintain capital controls, but don't tighten them further. They intervene in markets, but not as aggressively as January 2026. Foreign capital continues to slowly exit, but not in 1 week, over years. China's equity markets stagnate. Valuations stay low, returns are mediocre. Foreign investors maintain minimal exposure for diversification, but don't add. China becomes a permanent underweight in global portfolios. This is the most likely scenario. Slow stagnation, not collapse, but not growth. A perpetual discount market that nobody wants, but some hold for completeness. Here's what this means for you. If you own Chinese stocks, either directly or through emerging market funds, understand the risk. Beijing will sacrifice returns for control. They proved it in January 2026. Your upside is capped. When markets rally too much, the government will intervene to cool them. When markets crash, the government will intervene to support them. But the interventions aren't for your benefit. They're for stability, for control, for the party. If you accept that, fine. But don't expect market returns. Expect administered returns, capped upside, managed downside, and constant political risk. If you're allocating capital, consider the alternatives. India is growing faster, with better governance. Vietnam has higher GDP growth and is taking manufacturing share from China. Indonesia has a massive domestic market and commodity wealth. Taiwan and South Korea have advanced tech sectors without political interference. Even Japan, with its aging population and slow growth, has more transparent markets than China. You don't need China exposure to get Asian growth. In fact, China might be the one Asian market you should avoid. Here's the final piece. This is about more than markets. This is about the world order. The post-1980 global system was built on integration, free trade, open capital flows, integrated supply chains. The idea was that economic interdependence would create peace because war would be too costly. But Beijing is proving that wrong. They're showing that a major power can decouple, maintain control, and still survive. Not thrive, but survive. And survival is enough for the CCP. They don't need foreign capital if it comes with foreign influence. They'd rather be poor and in control than richer and subject to market discipline. This is the new reality. China is choosing autarky over integration, control over growth, stability over returns, and foreign investors are responding by leaving. $49.2 billion in 1 week. That's the wake-up call. Wall Street finally understood that China's markets aren't markets. They're policy tools. And you can't invest in policy tools when the policy changes arbitrarily to suit the government's stability goals. Here's the data point that summarizes everything. In 2021, foreign investors held about $700 billion in Chinese equities. By January 2026, that's down to roughly $500 billion, $200 billion exit in 5 years. And it's accelerating. The exodus is no longer gradual, it's rapid. And it's rational, because the risk-reward is broken. The reward is capped by government intervention. The risk is unlimited political uncertainty. No professional investor will accept that trade. So they leave. And once they leave, they don't come back. Because reputation, once destroyed, can't be rebuilt without fundamental change. And change isn't coming. Beijing's actions in January 2026 were a turning point. Raising margin requirements the moment markets rally. Deploying the national team to sell rather than buy. Restricting high-frequency trading to slow the market down. These aren't the actions of a confident financial center. These are the actions of a government terrified of losing control. And when a government is terrified of its own markets, investors run. Because if the government is scared, investors should be terrified. Wall Street just pulled $45 billion out of China in 7 days because they saw the writing on the wall. Actually, they pulled $49.2 billion, but who's counting? The point is, this is the beginning of the end for foreign capital in Chinese equity markets, not the end itself. That'll take years. But the beginning, the moment when everyone realized the emperor has no clothes, China's markets aren't free. They're controlled. And controlled markets don't generate returns. They generate propaganda, and you can't retire on propaganda. This is the story they won't tell you on CNBC. They'll talk about trade wars and tariffs and GDP growth, but the real story is control. Beijing values control more than capital, and capital, finally, is responding by leaving. $49.2 billion in 1 week, the largest exodus ever recorded. And it's not coming back. Because once you understand that the Chinese government will sabotage its own rally to maintain stability, you understand that there's no investment thesis. There's only political risk. And professional investors don't get paid to take political risk. They get paid to generate returns. And in China, Returns are now a policy decision, not a market outcome. So if you're wondering why Wall Street just pulled $45 billion out of China in 7 days, now you know. They finally saw what's been obvious to anyone paying attention for years. China's markets are not markets. They're livers of state control. And you don't invest in state control. You avoid it. And that's exactly what's happening. The great decoupling. The financial separation of Western capital from Chinese markets. It's not coming. It's here. And January 2026 is when everyone finally woke up to that reality. If this opened your eyes to what's really happening in global markets, if you finally understand that the $4,902 billion exodus from China in 7 days wasn't panic but clarity, then you're seeing the architecture of global finance shift in real time. Subscribe if you want to understand these shifts before they happen, not after, because by the time mainstream media tells you, the smart money has already moved. And in January 2026, the smart money moved out. $45 billion in 7 days. That's not a trend. That's a stampede. And stampedes don't reverse. They accelerate. Welcome to the new world, where China is on one side and capital is on the other, and the gap is widening every single day. Now, I want to hear from you. Do you think China can reverse this capital flight, or is the decoupling permanent? Drop your thoughts in the comments below. If this video changed how you see global markets, hit the like button and subscribe, because we're just getting started. And if you want to understand how we got here, how the debt system was designed to trap entire nations, click on the video appearing on screen right now about the 4 bankers who built the global debt trap. That's where this story really begins.